If you're here, you're probably exploring the idea of buying a home directly from the owner by assuming a VA or government backed loan. I'm Elbert Zeigler, and I'm excited to introduce you to my home at 1810 Southwest First Place in Cape Coral, Florida, at an asking price of $390,000 with a VA assumable mortgage at an incredible rate of 2.375% and a monthly payment of just $1,400, PITI included. This could be your chance to own a piece of Southwest Florida without the traditional hassles. Here's the best part. The mortgage balance is $255,000, and that means you can step into this home with an assumable mortgage that could save you thousands in financing costs. It's an opportunity that doesn't come around often. The following videos will walk you through everything you need to know about VA assumable mortgages, how they work, and why this option might be the perfect fit for you. It's like a points buy down to an interest rate of 2.375% at no cost. If you assume this loan, there is no appraisal fees, title insurance is paid, and no loan origination fees. PennyMac Mortgage will handle the closing with their loan officer and lawyer. PennyMac will handle the assumption for you and me. Your monthly mortgage payment will be about $1,400 per month. So, whether you're a first-time buyer or someone looking to make a smart investment, join me on this journey. Let's explore why my home could be your next dream home, or find one like it. Let's make you a move. Watch the first video, Assumable Mortgages Explained, and begin to understand why it's better to buy a house for a higher price and a lower interest rate than it is to buy a house with a lower price and a higher interest rate. I'll leave a link to all of my video collection in the comments. Thank you.
American home buyers have enjoyed 32 years of declining mortgage rates, falling from an early 1980s high exceeding 18% to a low of nearly 3% in 2013. Lower interest rates help home buyers by reducing mortgage payments, or allowing them to afford a more expensive home for the same payment. But what happens when interest rates eventually start to move higher, as we've already started to witness recently? Does this mean home affordability will decline? Yes. Homes are already becoming less affordable. For example, at 3%, $1,000 a month could have supported a mortgage of $237,000. At 5%, it would support a $186,000 mortgage. And at 7%, a buyer will only be able to afford a $150,000 mortgage. Fortunately, there is still a way to take advantage of the historically low interest rates of the past several years: assumable mortgages. An assumable mortgage allows for the seller of a home to transfer an existing low-interest rate mortgage to a qualified buyer. The buyer simply pays the difference between the seller's outstanding mortgage amount and the agreed purchase price. If that difference is more than the buyer has available for a down payment, additional financing may be available. And the best part is, the buyer and the seller can both share in the benefit. The buyer benefits because his monthly payments are lower, and because his payments are lower, he might be willing to pay a somewhat higher sales price, perhaps the full asking price, providing the seller with the benefit too. In addition to lower monthly payments, buyers can also save on closing costs. Since there is no mortgage broker or loan officer in the transaction, there are no mortgage commitment fees. Similarly, appraisals and their associated fees are not usually required. So what types of mortgages are readily assumable in the U.S.? Loans that are backed by the U.S. government, including loans insured by the Federal Housing Administration, loans guaranteed by the Veterans Administration, loans guaranteed by the U.S. Department of Agriculture. The amount of these outstanding assumable loans has grown dramatically since the financial crisis began in 2007. As bank lending dried up, the Federal Reserve, Congress, and other governmental agencies worked to keep interest rates low and home financing available. This timely action resulted in the creation of large amounts of government-backed assumable mortgages that offer value and opportunity to home buyers and sellers. The increase in government-backed funding has been so significant that assumable loans now make up more than 1 out of every 6 mortgages across America. Now that so many American homes have assumable mortgages with low interest rates, this is a great opportunity for today's buyers and sellers. With rates approaching 5%, there are already homes for sale that offer buyers lifetime savings of $30,000, $50,000, or even $70,000. These savings opportunities will only grow as rates rise. In fact, if interest rates return to their historical levels, 9 million homes across America will offer American homebuyers savings totaling more than $1 trillion. To learn more about assumable mortgages, or to search for a home with an assumable mortgage, visit the industry's leading website, Zumption.com. Zumption.com. Assume the best.
Look at this report from NBC4 about assumable mortgages. Navigating the home buying process, especially with VA mortgage assumptions, can be overlooked due to their rarity. Sellers, buyers, and agents may hesitate due to the unfamiliarity, but I aim to share valuable insights for sellers like me and buyers like you. Just Google Doctor Calculator to see the difference a 2.375% interest rate makes over 30 years compared to higher rates. It's clear, paying more upfront for a lower interest rate results in substantial savings over time. It's counterintuitive, but financially smart. Real estate agents may not fully grasp the benefits of assumable mortgages, so choose agents wisely. If you must use one, you can manage this process independently and save on unnecessary fees for both buyer and seller. Don't overlook this opportunity. Wake up to the savings potential and seize this once-in-a-lifetime deal before it slips away. Look at this report from NBC4 about assumable mortgages.
Need to wait too much longer.
So assumable mortgages allow buyers to purchase their dream home with low rates. Consumer reporter Susan Hogan is working for you now with a breakdown on how it all works.
I like it. Ready to purchase their first home, Sarah and Terry Diamond spent months searching for the right fit.
Space.
Bigger kitchen, bigger lot.
They settled on a house with a big yard for their kids and financed it with an interest rate of just 3.125%.
Anyone I've told, like, close work friends that work next to me and stuff like that, I think I'm lying to them. Yeah, they're like,
I think
how'd you get
those
3%? And I'm like, assume below.
An assumable mortgage, in basic terms, it means a qualified buyer takes over the seller's loan, including the interest rate, payment schedule, and loan balance. Some of you may recognize an assumable loan as a vestige of double-digit interest rates. In 1981, buyers were looking at 18%. Today, the Diamonds real estate agent says houses with assumable mortgage gets lots of interest.
It was a huge selling point for the reason they chose this home.
As with any major financial decision, Justice T. Carbaugh explains there is a list of trade-offs to consider. The buyer would typically have a bigger down payment. For example, if someone is buying a house for $400,000, taking over the seller's assumable mortgage with a $300,000 balance, the buyer would need to cover the $100,000 difference. Carbaugh says it can be doable, especially for buyers who are coming out of a home that saw an increase in its value.
Any home buyers that maybe bought their home when the market was great, when everybody was happy, between late 2018 to 2020, have a ton of equity.
Another important distinction: conventional mortgages are not generally assumable other than very specific circumstances like a spouse assuming one in a divorce. Only certain government-backed VA, FHA, or USDA loans can be transferred to a new buyer. A new owner doesn't have to be a veteran to assume a VA loan, but the seller should consider their VA entitlement. It would be tied up as long as the buyer keeps the old loan. With FHA loans, real estate agent and broker Jared Ty points out buyers typically have to pay a mortgage insurance premium.
Obviously, you want to weigh, each scenario, but it can absolutely make sense to do the assumption.
We wondered, how would a buyer find a 2024 house with a 2021 interest rate? Well, we looked at real estate websites, adding assumable as a keyword in the advanced search. Listings that mentioned 2, 3, 5% assumable interest rates came up. Ty says this information isn't always in the marketing, so it helps to know what questions to ask.
It never hurts to, have your agent call and say, hey, what kind of loan do they have on the current house? Let's see if we can get creative.
We had no idea what an assumable loan was before we dove into this.
It worked for the Diamonds, who are now moving into their precious house.
We have a house that we can actually afford. We can afford to do upgrades to throughout the years because we're not spending $4,000 per month on a mortgage.
As with any big decision, read the fine print, of course, and do your research and get qualified help. As for the seller, make sure the assumption is approved by the lender to confirm you are not on the note anymore in case the new owner later defaults. Also, buyers would have to meet certain criteria to qualify and factor in additional fees.
Consider the opportunity presented by this home at 1810 Southwest First Place, Cape Coral, Florida, priced at $390,000 with a 2.375% VA assumable mortgage of about $255,000 and a monthly payment of $1,400 and a $130,000 down payment. It's clear paying more upfront for a lower interest rate results in substantial savings over time. It's counterintuitive, but financially prudent. Just to remind you again, buying this house for $390,000 with a 2.375% interest rate and assuming this loan could save you over $1,000 per month in payments, $12,000 annually, and a staggering $264,000 over the loan's life. Do the math. This is an unparalleled opportunity. No conventional mortgage can match this rate. We're looking for a buyer who can qualify for a conventional mortgage and handle the equity stake of approximately $130,000. Offers should be accompanied by a pre-approval letter or proof of upfront cash.
And now you might be telling yourself, why would somebody pay so much more? Nobody buys a house based on the price unless they're paying cash. And that's not very many people these days. They buy it based upon the payment. And if you look at an amortization schedule, let's say if you're sitting at your computer listening to this, Google the term doctor calculator. That's a fantastic mortgage calculator. It's Carl's mortgage calculator is what it's called. Go look at the difference. Do $400,000 mortgage and look at what 3.5% interest rate on a 30-year fixed is going to cost you per month, and then look at what it costs you over 30 years. And then do the same thing at 7. And you will see that it really makes sense to pay more and get a lower interest rate than it does to pay less and get a higher interest rate.
This next video covers everything you need to know about the VA assumable loans. If you're looking at buying a home, but you're stunned by the monthly mortgage payments that come in around 6 to 7% interest rate and some up to 8%, it could be a VA assumable loan could be just the ticket to save you hundreds or even thousands of dollars. From 2020 to 2024, Florida home prices surged 45%, while interest rates and monthly payments skyrocketed to 130% and 130% respectively. But here's the twist. You could turn back time. In a rising interest rate environment, seizing a VA assumable mortgage makes perfect financial sense. This video is tailored to inform buyers who understand the advantages of paying a premium for this property, even above market valuations. It equips you with essential resources to navigate each transaction phase. This isn't for traditional agents who may not grasp VA-backed mortgages. In fact, some agents might try to dissuade you from a for sale by owner VA assumable mortgage to protect their 6% commission. Consider consulting a real estate attorney instead. It could save both of us a significant amount of money by bypassing the costly middleman.
With interest rates between 6 and 7%, how can you get a rate around 4% to save hundreds or even thousands a month in your monthly payment? We're diving into assumable loans, pros and cons to them, and how you can use them to score a much lower monthly payment. Or if you're selling your home, to use them to market your home to more buyers and perhaps get a higher selling price. We're covering everything you need to know in this video about assumable loans. Hi. Neil here. If you're looking at buying a home, but you're stunned by the monthly mortgage payments that come in around 6 to 7% interest rate, it could be that an adjustable loan could be just the ticket to save hundreds or even thousands of dollars a month. And if you're selling a home, the assumable loan can help give you a tremendous marketing advantage to sell your home. And we're covering all that in this video. Assumable loans aren't really talked about until interest rates get high like they are now. If you're looking at buying or selling a home with an assumable loan, just reach out via phone, text, or email so we can run through your options. I've got people contacting me all the time just like you who have the same concern, and I absolutely love helping them. Now, it's important to note that many agents just don't understand assumable loans. So you really want to make sure you're working with an agent that understands assumable loans, like myself, to help guide both buyers and sellers through the process. So just call, text, or email me and let's chat. First, let's cover what an assumable loan is before we cover the pros and cons. An assumable loan is simply a loan that can be taken on by a buyer. So the buyer assumes the monthly payments of the seller and the interest rate. So if a homeowner has an interest rate, let's say of 2.75%, the buyer takes over the payments with that interest rate. There is a catch to this, and we'll cover that in the buyer cons coming up in just a few minutes. However, not all mortgage types are assumable. Typically, VA loans and FHA loans are assumable, as well as USDA loans. Conventional loans typically are not assumable. And some adjustable rate mortgage, or ARMs, will allow an assumption, but that kind of defeats the purpose since they tend to adjust, up and down quite a bit. VA loans represent the biggest opportunity because they typically have the best interest rates, and they are almost always assumable, and they can be assumed by a veteran or a non-veteran. The buyer also doesn't have to be a first-time home buyer. So selling to a veteran is best for the seller of the home because it allows the seller to regain entitlement and allows the seller to go out and buy another home with a VA loan. If selling to a non-veteran, although the seller has no obligation to the mortgage, the entitlement is tied up to that property and cannot be used by the VA loan again until the buyer pays off the loan or refinances out of the VA loan. Many VA loans have rates around 3%, which makes it super attractive to a buyer. Next up are FHA loans. FHA loans are always assumable and can be a great opportunity for the lower mid-price range homes. USDA loans typically are also assumable, and they're going to be for low to more moderate incomes. The buyers must meet the strict income limitations in order to qualify for the loan. Here are a few rules to keep in mind before pursuing this too far. The buyer must be an owner-occupant, so you have to be buying this as your primary residence, not an investment property. And the buyer must, of course, qualify for the loan. And the seller must typically have lived in the house for at least 1 year before doing this. So let's cover some of the pros and cons to the program. It allows the buyer to take over a lower interest rate. Typically, you're going to be dealing directly with the loan servicer, not a loan officer. That saves you some closing costs like origination fees. And you're only paying the remaining payments. So maybe 25 years are left on the mortgage rather than 30 years, for instance. This is going to save you some interest over the long run because of the 5 years less of payments. Now, let's look at some of the cons to the assumable loan for a buyer. First, you're going to have a high down payment. There really is just one main con to this, and that is there may be a substantial down payment required. Only the remaining loan amount can be assumed by the buyer, and the buyer will then need to cover the cost between the purchase price of the home and then what's left on the mortgage. In other words, the amount remaining to be paid on the mortgage. And the house is being purchased, let's say, for $600,000. The buyer would have to pay the difference of $300,000. There are a couple of ways to overcome this if you don't have access to that kind of cash. Number one, you can use gift funds from family and friends to cover the difference. Two, you can get a second mortgage through a lender to cover the difference. Three, you can use seller financing to cover the difference. So you'd make arrangements to the seller at an agreed interest rate to cover the $300,000 difference in our example. If the seller charges 6% interest and you're taking over a loan with 3% interest, you'll have a blended interest rate of 4.5%. Now this is a huge win. It allows you to buy the home potentially with no money down, allows the seller to get their desired price, and the seller makes a little extra money on the interest payments. Let's look at the pros for the seller. First is the increased marketing exposure for your home. With high interest rates, you can advertise that a buyer can take over a 3% rate, for example. It's going to help attract buyers to your home. A realtor who understands assumable loans, like myself, sitting on a gold mine to market your home and bring a bigger pool of buyers. This helps create demand and get the price you want. Using the seller financing option I just talked about will also help you net you the interest earnings on top of the sale. Let's look at some cons for the seller. First, it can take longer to sell your home. You and your realtor need to know everything about what the servicer is going to require and how long it will take. Servicers aren't as familiar with this because they haven't done them in a while. Things could take longer and the exact close date, may be unknown. A second con is entitlement for VA loans. As mentioned previously, if you're selling to a non-veteran buyer and your entitlement will be tied up, making it very difficult to buy another house using a VA loan. Third is qualification of the buyer. The buyer won't be fully qualified until you get into escrow because they have to get qualified with your loan servicer. Hopefully they're already pre-approved by a lender. Then you know they have a high probability of being approved by the loan servicer. Let's look at some of the best practices with assumable loans. 1. As a seller, you must get a release of liability from the loan servicer and sign it so you aren't on the hook if the buyer doesn't make the mortgage payments. 2. Talk to your loan servicer at least a month before you put your home on the market. You want to have all your ducks in a row on this before you list your home. 3. Marketing has significant advantages if you have this option because you'll get a lot more activity on your home. So make sure you promote this in all of your marketing materials. Number 4, as a buyer, you want to focus on homes sold in the last couple of years. Otherwise, the seller could have a ton of equity requiring a second loan or a significant down payment. And lastly, at number 5, make sure you're working with an agent like myself that understands assumable loans so they can work with the servicing, mortgage officers, and helping the buyer and their agent all the way through the whole process. If you're looking to buy or sell a home using an assumable loan or any other loan product, then make sure you reach out to me via text, phone, or email for a no-cost, no-hassle obligation consultation. I've got your back.
This video is about CNBC interviewing with Rome, educating everyone, now you, about VA assumable mortgages. Here's what you need to know about my VA assumable loan deal. 1. You have PennyMac mortgage assurances that their assumption specialists will manage every detail of the process, ensuring a smooth transaction. 2. Show your financial readiness with proof of funds or pre-approval for a second mortgage. 3. Consider the substantial monthly savings. A lower interest rate could slash your payments by up to 50%, allowing flexibility to meet the asking price of $390,000. An assumable mortgage offers the most affordable path to home ownership. Assuming this mortgage requires trust in capable hands, PennyMac is here to guide you and me through every step. Their experience dates back to a time when mortgage assumptions were more common, unlike today.
With mortgage rates soaring past 7 and after today maybe near 8%, 7.5% about as you can see there, home ownership has become even more difficult for many. But real estate startup Rome is trying to change that with assumable. Didn't Tyler Matheson just tell me about this?
We were asking about this yesterday.
Assumable mortgages. That means when you buy the house, you get to take over the mortgage from the sellers as well. Now their interest rate might be anywhere as low as 4%, 3%, maybe 2%. Now, you as the buyer still have to cover the rest of the purchase price, of course, but here to talk about it is Ronak Singh. He is the founder and CEO of Rome. Thank you for joining us.
Thank you so much for having me. It's a pleasure to be here.
So Tyler brought this up because this used to be much more common, as I understand it, but has gone by the wayside?
Yeah. So, right now we're focused on loans that are fully assumable, so those are government-backed loans. Now, Rome helps buyers wind back the clock on mortgage rates and purchase a home with that low-rate, fully assumable mortgage included. And the benefit is for buyers, they get to reduce their monthly mortgage payment by up to half compared to purchasing a home at today's prevailing rates.
So ironically, they benefit the most if the mortgage that they're buying is very large, right? So
Yes.
like, if someone only has $300K left on the mortgage and you need to take out a new mortgage for the other 300, you know, I mean, it still helps, but you know.
Yeah, so right now we actually focus on the homes where you see the mortgage was originated, say, in 20 or 21. So the loan to value ratio is often, you know, above 75%, which means that the down payment the buyer would need to make is very similar to that of a conventional mortgage, say 20% or 25%. But the value is that their monthly payment would be about half of what it would be at today's prevailing rate.
It's loan to value based on current value or the value of the property when the loan was originally taken out, because houses have actually gone up quite considerably, sometimes 20-30% since then. So I may have an outstanding mortgage of $300,000 on a house that I paid $380,000 for, but now that house is worth $500,000.
Yep.
And so I've got to come up with $200,000 in cash.
Right.
Where do I do that?
So what would happen is we work with you as a buyer around what your preferences are. So if you're able to come up with the full amount in cash, we'll help you with that. But if you need some support, we actually can refer you to that a second lien lender. And these preferred providers will help you calculate the savings and ensure that your blended rate is still way below the market rate.
Okay, so I'm reading in a Wall Street Journal article that the FHA has processed 3,349 assumptions in the fiscal year that ends September 30th. There must be tens of millions of mortgages that would qualify for assumption. Why have only 3,400 of them been done?
Yeah. So this is actually a large part of the problem we set out to solve with Rome. We found that most consumers actually don't know this is a benefit that is given to them by law.
Really?
So yes, in fact, I watched the segment yesterday. I think you had a guest on who had mentioned only certain kinds of FHA and VA loans might be eligible, or it might be in isolated incidents. And so this is a large part of what we're trying to correct the record on. You know, it's actually all government-backed loans are fully eligible for the assumption, and this is an opportunity for most consumers.
So is it a question of people just not asking? Is your loan an FHA or VA-backed loan? The buyer not asking, or the real estate agent not asking, so that can be listed on the write-up of the property, so that
the attraction,
so that I can immediately see that this has a 3% loan assumable.
I entirely agree. So there's two key issues I think that prevent there from being more attraction that we solve with our product. The first is it's been pretty difficult thus far to be able to discover these homes. Let's say you were shopping for a home in Atlanta. You would probably go to Zillow and use the keyword search function to try to find an assumable mortgage. And if you did, you'd find maybe 3 or 4 results. But if you hop on over to withrome.com...
Because it's not on there.
Exactly.
Nobody's thought to put that as a data point.
Because of the lack of awareness, people don't know they should be advertising the affordability benefit of their assumable mortgage. So when you're a seller or a listing agent and you hop on over to withrome.com, we help work with you. We understand your interest rate, your remaining mortgage balance. We help frame it in the right way to the buyer so they know that your home is the only one in the neighborhood they can afford because it comes with that 2% mortgage included.
And you get paid what to do this?
So we charge 1% of the sales price, and the way we represent this to the buyer is we say, look, our incentives are aligned with yours, right? If you save money, we help you make money. And so the way we think of this is, for them, the closing costs are going to be still much lower than a traditional mortgage. There's actually no appraisal required in an assumption because the loan has already been originated.
So on that note, we've been talking a lot about the 7% mortgage rate. People say, well, if it were still 3%, different story. You checked in with Rome and its CEO. We've talked to them on the program before. They're trying to help people do assumable mortgages. So you buy the house, you get the low mortgage with it. And they've got some new things up their sleeve, do they not?
They do, Kelly, yeah. So let me explain. An assumable mortgage is when you buy a home and you take on the seller's mortgage at their rate. Now, this is only allowed on FHA and VA loans, but there are $1.5 trillion worth of assumable loans that were made at the start of the pandemic, remember, with those record low, crazy 3% rates. Now, in the past, these loans have been kind of hard to find and hard to do. So, as he said, Rome launched last fall as a company that lists homes with assumable mortgages and then facilitates the transactions. But there was still an issue, namely that while you take on the old mortgage, you still have to come up with the outstanding principal. And given how much home prices have risen in the last 5 years, that can be a lot. So Rome is now announcing that it's working with a lender, Cerberus-owned Spring EQ, that will make up the difference using a second loan.
that give buyers a generational gift to be able to wind back the clock on rates and purchase that home with a mortgage as low as 2%. And we may never see those rates again.
So the second loan will be at the market rate, but it's much smaller than the first loan, so when you blend the two rates, your overall payments are going to be much lower. There is a catch, though. The assumable mortgage has to cover at least 50% of the sale price of the home.
We curate all of the homes that you see on withrome.com require at least 50% of the sales price to be met by the mortgage, and usually you'll find the interest rate is around 5.5% or less. Meaning that we've curated the most attractive homes from both the down payment perspective and from a rate perspective.
And you do still need to put 15% down in cash. But again, this is a creative way to lower your overall mortgage rate and your monthly payment in, as you said, Kelly, the 7% environment. And don't forget, though, Rome takes a 1% commission cut on it.
Right, although it's still good to know what different ways people are trying to come up with to continue to make housing attractive. And I wonder what we could ever do. It's almost like the sellers might say, no, I want to take that mortgage with me.
Yeah.
That's what's keeping
Wouldn't you
people
love
locked
that?
in place. Right, exactly.
No, that's not possible yet. I mean, you can do it with a sale, and it makes selling more attractive as well because sellers are going to get a lot more buyers if they've advertised that they have this assumable mortgage. Rome was saying that they get 5 times more buyers. Not that it's so hard to find buyers right now, but again, it does make the transaction more attractive.
Yeah, maybe it gives them the best price and so forth. Diana, thanks very much. We appreciate it. Diana Oleg.
This video talks about a buyer who just assumed a 2.875% mortgage. If you're not convinced yet or haven't learned enough about assumable mortgages, watch this next video. I have a similar deal waiting for you, here and now. Get it before it's too late and this deal becomes outdated on video on YouTube, but the information will remain fresh.
My buyers just bought a house and assumed a 2.875% mortgage. This is the equivalent of a 30% discount to what they would have been paying. It's absolutely insane. What makes it crazier is that this listing was not advertised. If you go to Redfin or Zillow and you search assumable listings in your area, you're likely to find very few. And the few that you do find, the majority of them will be VA. Now, I'll just go ahead and tell you, this is not VA loans. You don't have to be a veteran. All you have to do is be qualified for a conventional mortgage. But the problem is nobody is advertising that these are assumable. In fact, of the 84 active listings right now in Nashville that are FHA assumable, and by the way, these 84 are 84 from 2021 FHA loans. One is advertising that it's assumable. One. So we actually found one that was assumable. We worked with our buyer to get them into contract. Now, I knew that if we made an offer requiring assumption, this was a competitive house. It had multiple offers. And fortunately, we got in contract before those other offers were made. But we didn't even bring up assumable. Why? Because it would have been a non-starter. They were going to get offers. Why would they work with somebody for an unfamiliar process and do an unfamiliar thing that everybody's saying you can't do? Why would they do that? They wouldn't have taken the offer. So what we did was we got into contract, and then I offered a half a point of my commission if we could pursue the assumption of the seller's mortgage. Okay? Because I knew that the seller had an FHA loan, and all I wanted them to do was make a best effort. I also knew that my buyers needed a house. They were going to buy this house either way. Okay, but when we offered a half a point of my commission, it's $2,500 on this house, they were like, sure, yeah, we'll help you. We immediately went to the servicer and we closed it within 4 weeks. Guys, it wasn't any harder than qualifying for a mortgage. In fact, in some ways, it was easier. I will talk to you about some of the pitfalls, but the biggest pitfall in the whole process is that people are unfamiliar with it, that realtors will tell you you can't do it, that banks will tell you you can't do it. In fact, the mortgage servicer that ended up giving us this assumable mortgage told us twice that we could not do this. We had to literally send them a very direct email telling them their own rules and why HUD required them to assume this mortgage. And then they allowed us to assume it. But that being said, we didn't have to change close date. We didn't have to change anything in our contract. We delivered on everything we put in our offer. And the seller worked with us, we worked with the seller, and they got a 2.875% mortgage. So let me hit a few things really quick, both misconceptions about FHA loans and the hurdles it takes to assume mortgage. Now, we are talking about FHA loans, okay? So typically when people think FHA loan, they think first-time home buyer or, lower quality house, cheaply built, cheap houses. This is all not true. Of course, there's a spectrum of homes. There's low-cost homes. There's also extremely expensive homes, just like I showed you. But you don't have to be a first-time home buyer to pick up, to assume an FHA mortgage. And in fact, there's no upper income limit on these. You just have to qualify through a manual underwriting process, which sometimes has different rules. But in general, if you qualify for a conventional loan, you can qualify to assume an FHA loan. Okay, it's not that hard. Okay, the other thing is this misunderstanding that it takes a long time to close. That is false. VA loans assumption takes a long time to close. FHA is required by HUD to be 45 days or less, and we closed ours in 4 weeks. We didn't even engage the mortgage servicer until after our inspection period was over, which was almost 10 days into the contract. And we went under contract on May 27th. We closed on July 7th. And keep in mind, there were 2 holidays in between. So it's not like we had a bunch of business days to spare. We did this very quickly. Sellers do not know that these are assumable. They're not going to tell you, but they will work with you if you tell them. And if you do, like we do, we actually offer a financial incentive to the seller to work with us on assuming, and it makes a difference. Nobody understands the process, okay? I'm just telling you, that's the biggest hurdle, is everybody's so uncomfortable. Now, we did it in 4 weeks, so it's not that hard. But I'm telling you, if you talk to your agents, they're going to tell you you can't do it. If you talk to bankers, they're going to tell you you can't do it. Nobody's making money off this, and so they're not going to help you do this. And that's the tragedy, is that 98% of these houses that are listed right now are going to be sold and no assumption is going to happen. And that's just really, really a tragedy for the buyers out there who are trying to do the best they can. You have to be a primary residence. This is for people who are trying to buy and live in a house. This is a great opportunity, but guess what? It keeps investors out. It gets much less attention. So people aren't paying much attention to this. Okay, we talked about credit requirements. Don't need to talk about that again. You do have to have the seller's permission. Now, the good news for the seller is they're completely relieved of liability. So if a seller goes through this process, they're relieved of the liability. You own the loan when you buy the house. And if you stop making payments, the foreclosure and the credit and everything else, it comes back on you. The seller is completely relieved of any liability. The biggest hurdle I see on this is a large down payment. Guys, it's going to take a large down payment. You are going to need, at minimum, probably $30,000 to be able to do this. And it can go all the way up to what my buyers had to put down was $160,000. Now, they were fortunate because they weren't first-time home buyers and they made a lot of money from their previous home. So they were able to buy this house and pay the difference between the sales price and the loan value. So the best situation here is if you have a decent amount of money you can put down, this is a really, really solid approach, and that would be the biggest hurdle. Again, this is the greatest wealth hack there is. If you are a buyer or a seller, if you're a seller and you don't know whether or not you have an assumable mortgage, reach out. I would love to help buyers and sellers capture this assumable mortgage, because if you don't capture it, it just gets paid off and it disappears and nobody gets that value. It goes back to the bank who has an overinflated asset on their balance sheet, and that makes me sad. So with that being said, I hope you guys have a great week, and I look forward to seeing you next Saturday.
Okay, you're still here at the end of this video. That means this was some pretty interesting and educational stuff for you. You just got schooled on VA and government-backed assumable loans and the super low interest rates from 2 to 4%. That's huge. I have 2 more videos to finalize this collection, and then you'll know more than the most real estate agents. They don't know everything and very little about VA assumable mortgages. This education, take this education and make your own decision for your financial future. I only have 1 home to sell, and when it's gone, it's gone. But there are plenty more out there. You know how to find and hunt for them now. Save your financial future. Assumable loans makes financial sense. This video serves as an advertisement to sell my home to qualified buyers. It's packed with insights from research on VA assumable mortgages from reliable sources like YouTube University. You've all been there. I go there all the time. It's intended to demystify the process and encourage sellers and buyers to consider VA assumable homes for sale by owner, saving on high commission fees and paperwork. Call Uncle Elbert and take advantage of this offer now. 239-457-6345. Thank you, and I hope this video helps you understand assumable mortgages.
We are going to be talking about something that is amazing. It's a once-in-a-lifetime thing that happens, and it is an assumable mortgage. So if you're a seller and you have this great low interest rate, maybe 3.5%, 4%, somewhere in that range, and you're like, listen, I got to sell my house, and the values have dropped, and I might be even upside down or really close, I'm going to show you how you can get top dollar for your house. Pay attention right after this. Hey, I'm Gary Meek with the Living in Sacramento team, and you have turned on YouTube today. You are checking us out. You are checking out our channel, finding out about assumable mortgages. Now, we are specifically talking to the sellers today. I did a different video that is about the buyer side and all the benefits to them. So that is a great thing you guys should check out on the channel. But for today, we're talking about the sellers. So you as a seller have decided, hey, I got something happening in my life, big life change. We're downsizing, upsizing. We got to move out of the state. Somebody lost a job. Hopefully no one got sick, anything like that happened. But for you sellers that have interest rates in the 2, 3, 4%, and you are a VA or an FHA loan, your loan is assumable. Now, I'm not sure if you guys knew that, but it is. So let's talk about some of the details. First and foremost, it's only FHA and VA. So if you have an FHA loan, a buyer can assume that loan that you have with very little cost to them because they don't have to go through the whole mortgage process. So the cost to assume the loan is only like $1,500. Now, it does take a little bit longer, probably going to be in the 60-day range for the person to assume the loan, which, hey, that's just one of the things that we got to deal with. But here's the thing. You are selling your property in time right now where the market's shifting, interest rates are up. Not a lot of buyers out there, and some of the values have actually come down. Possibly you bought your house at the end of 21, early 22, you got the great rate, but you paid absolute top dollar for your house. And hey, maybe it's kind of upside down right now or really, really close. So what if we could help you sell your property in today's market, but we're not going to sell it based on the value really where it is today. We're going to sell it based on the payment. So we're going to jump in and show you guys the differences in payments and how we can help you as a seller. All right, so we're going to jump in here and we're going to talk about our interest rates and we're going to talk about our payments. You'll see that I have a mortgagecalculator.org. That is a website I go to, I use all the time. If you want to check this website out and punch in your own scenario, you can. Well, let's check this out. So the very first thing, we have a buyer that's looking to spend $500,000. Happens to be that you paid $500,000 for your house. Maybe it's only worth $480,000 right now, but nonetheless, we're talking about a $500,000 valuation. So if a current buyer goes and gets qualified for $500,000 and they have a down payment of about $20,000, that's FHA, 3.5% down and some closing costs, end up with about a $480,000 loan and a 7% interest rate. You'll see I have property taxes at $5,000, PMI, HOA, homeowners insurance, and you'll see that it's FHA. I calculate this here, and you'll see that a buyer in today's economy is going to spend $3,900 in order to buy your house, right? That is a big number. And my guess is you're not paying anything near that. So here's probably what you're paying. So we're going to say that you have a 4% loan. You'll see that I have the information here is exactly the same. $500,000 house at a 4% interest rate. Your payment's probably at the $3,000 range. So that's roughly a $900 savings to the new buyer. So if I could get a buyer that's interested in your house at $500,000 and they're going to be able to pay $3,000 a month rather than $3,900, remember the scenario, 7% is $3,900 and your rate at 4% and maybe even better, is at $3,000. So what if I could go to that buyer and say, here's the deal. It's $500,000 and you can buy their interest rate from them for 4%. So they're like, man, my $3,000, that's amazing. I'm saving $900 a month. Now we can go to them and say, listen, because the seller's willing to sell you this interest rate at this amazing rate, we need to get them some additional benefit. So the seller has to have some benefit as well, right? So we're going to say, listen, instead of $20,000 down, I actually need you guys to put $50,000 down. Now, that can easily be done, and they may have grandma and grandpa can help out. They might have money in 401k. Some buyers just have that money because they've been saving and saving and saving. And so now they have the extra money. They can put a little extra in your pocket and pay the commissions. There's lots of different ways to structure the deal. But what about this? What even if I could get that buyer to assume your loan, and then we did what's called a seller carry for the $50,000. They don't have the $50,000. They only have the $20,000. But we say, here's the deal. We're going to give you a $50,000 second owner carry. That means that buyer is going to pay you a dollar figure for the next 2, 3, 5, 10 years. All right. So here's our secondary finance. This is what we talked about, was the buyers coming with some additional funds. If they don't have it up front, they may have it on the backside. What we could do is we could let them buy your interest rate at 4%, and they're going to come in with that $20,000 down, pay the closing costs, commissions, all the stuff. And then we say, listen, you're saving $900 a month. That is an amazing savings to you as a new buyer, but we just can't give you that rate. We got to sell it to you. You got to pay us a little extra because we got that amazing rate. We got to make this equally, beneficial to both parties. So we could do a $30,000 owner carry, and we could do it for 5 years at 5% interest. And that means that buyer is going to pay you $566 for the next 5 years. So you're out of your house, you're on to the next thing, whatever that looks like for you and your family, but you're going to be getting $566 a month for the next 5 years. Not only are you going to get the $30,000, you're going to get almost $4,000 in interest as well. So you're going to make the extra, and you're going to get some interest. So you're going to sell your house for $500,000, do the regular $20,000 down, and then you get to do this amazing thing where you get a little extra cash for the next 5 years. Now, you think, well, that the buyer has to pay that. You're right. The buyer is saving $900 a month on their loan when they take over your mortgage rate or your interest rate. So for 5 years, if they have to pay $566, which is 2/3 of what they're saving. So they're still saving $300+ a month. They're still saving that money. And then in this 5 years, when this is up, they're now saving the $900. So to them, as a buyer, they're like, I'm still winning. I'm still coming out way ahead. And now this is a way for you as a seller to make some extra cash, right? So I want to stop this share right now, and I want to get back to this. So there's lots of ways we could arrange this, but for some people, it's actually going to be that you're upside down in your property. Very, very few, but there are going to be some where people are like, listen, we're struggling, we can't make it, we can't make the payments, we got to move, whatever it is. We're going to be able to say to that buyer, here's the deal, it's only worth $450 right now, but we're going to sell it to you at $500,000, which is above what it appraises for. But that's a great thing. No appraisal needed in an FHA assumable, right? But you guys are paying a little extra, but your payments are still going to be considerably less. So now they're getting the savings. They're bailing you out as a seller because you're upside down. And we do something, creative to get them to pay the commission. So you're saving a couple of bucks there also. So there's lots of scenarios. We would love to help you out. Like I said, I'm Gary Meek with the Living in Sacramento team. Not every agent knows this. Lenders don't quite fully understand this. If you want some more information on this, go ahead and message us in YouTube. Click on one of our links below. You can email us, text us, and ask more questions. Let's talk about your specific loan, your specific scenario, see how we can help you. And then the last thing is this. If you're thinking, I'm in a place where I'm actually in a good spot, I like my house and I like my interest rate, but I was thinking about selling and I don't want to sell because I'm not going to get this great interest rate again. I want to move up to a $700,000 house. Well, what if we could do the same thing for you? What if we could help you sell your house as it is today to that other buyer that's going to get your interest rate? But then what if we could help you get into another house that somebody else is selling that has one of those great rates? So you get to sell your house, get exactly what you want for it, and then you get to upgrade and get yourself a lower interest rate on the new house. The whole reason you did not upgrade was because of the 7% interest rates. What if I can get you that $700,000 house, whatever that number is for you, and I can get you that low interest rate? We can help. Message us, reach out to us, let us see what we can do. Hope you guys have a great day. Talk to you.
Do you want to know the secret of getting a lower interest rate than anybody else in today's high interest rate environment? They're called assumable loans, and today we're going to go over everything that you need to know about them. So let's go ahead and get into it. So over the last 2 months, more than any question that I've received, I keep getting asked time and time again about these assumable loan products. So I thought I'd make a special episode just dedicated to all things assumable loans so we can go over everything you need to know. So we're going to go over what an assumable loan is, what you need to do to qualify for it, and the pros and cons for both buyers and sellers if you are going to go through with this assumable loan product. So let's go ahead and start with what the assumable loan is to begin with. So the easiest way to explain it is that a homeowner decides to sell their house and they have a loan on the property. So let's say they're selling their house for $800,000 and they still have a loan for $700,000. So there's $100,000 of equity in the property. What an assumable loan allows you to do is the buyer can come into that and they can actually pay the down payment of that $100,000, so whatever the equity is in the property, and they can assume the loan of whatever the seller has. So if the seller has a great rate of, let's say, 3% on their interest rate, the new buyer gets that rate as well. And let's also say that the seller's been paying down that mortgage for 5 years, so when the buyer assumes that loan, they're not getting a 30-year mortgage, they're getting a 25-year mortgage, which means they can pay it off faster as well. So that's really just kind of the basics of what it is. Now let's go over what you have to actually do to qualify. So on the selling side of things, if you think you're going to sell your house, the best thing to do to figure out if you qualify for this is, one, you need to know what type of loan you have. Right now, FHA and VA loans are typically the only ones that are going to qualify for this product. So if you have a conventional loan, typically it's not going to work because there's usually a due on sale clause in a conventional loan. Just basically says that you need to pay off the entire loan. However, on an FHA and a VA loan, they don't have that, and they allow a new buyer to assume the loan as long as they can qualify. So as a seller, the first thing you want to do is talk to your lender if it is an FHA or VA loan and figure out if it is assumable, what is the process they have to go through. Typically what lenders are going to ask you is they're going to ask the buyer to basically qualify to take over that loan. So just like they would qualify for a new mortgage, they're going to have to send in their credit scores, they're going to have to go over their assets, their liabilities, their debt to income, all that stuff to make sure they can financially afford to take over that loan. Now, to make life simpler, typically sellers, you're going to want to do this before you even think about putting your property up for sale. That way you can get all the details, get the specifics from your lender to figure out exactly what you need to do to be able to use this product. That way you're not trying to figure it out when you get offers on your house and you get into escrow and then going through the whole process. It's better to know exactly how your lender is going to require you to go through it. But typically there's going to be some type of assumption package they give you for the buyer to fill out. And if the buyer qualifies, then they can go ahead and take over the loan. So let's say as a seller, you talk to the lender, they say it is assumable. Really the only other qualification typically that lenders are going to have is that you need to be living in that property for a year before you go through and try to do this assumable loan. So if you've lived in the property for a year and you have a VA or FHA loan, then typically there's a good chance you're going to qualify for this type of product. So it's definitely a good idea to talk to your loan servicer and figure out all the specifics you need before you go on the market, so that way you can market it properly, which we'll get into in a little bit. Now on the buying side of things to qualify, like I said before, this is basically like qualifying for a loan. So if you're already pre-qualified to have a loan, let's say of $800,000, and you're trying to take over this loan of $700,000, there's a good chance that you're going to qualify to be able to take over this loan because they're going to use a lot of the same guidelines. So hopefully now you understand the basics of this assumable loan product and what the basic requirements are. Now let's go ahead and talk about the pros and the cons for both buyers and sellers. So let's start with the pros first. Now, on the buying side of things, it's pretty obvious. The biggest pro that you're going to have here is that you're going to be able to take over a lower interest rate that the seller was able to secure before interest rates went up. So let's say the seller purchased a property 2 years ago and got an interest rate of 3%. You get to take over their payments on that 3% interest rate for the rest of the life of the loan. So that's obviously going to save you tens of thousands of dollars compared to today's interest rates that are hovering around 7%. So that's the most obvious financial advantage. However, there are more for the buyers. So on top of lowering your monthly mortgage payment and saving on a bunch of interest, when you go and purchase the property, you don't have to deal with a loan officer when you're doing this. Typically, you're going to be dealing directly with the loan servicer, which means there's not going to be any lender fees, and typically you don't need an appraisal as well, which is going to save you, again, hundreds if not thousands of dollars when you purchase this home compared to a standard sale. So again, that's just one more financial advantage that you have as a buyer when using this type of product. So the third and final benefit to buyers on this is going to have to do with the length of the mortgage. So let's say the seller has been paying that mortgage for 5 out of the 30 years. So they have 25 years left on the mortgage. When they do this and you take over the loan, you are not going back to a 30-year mortgage. You're just finishing up the payments on that 25-year mortgage, which means you're going to pay off your house 5 years faster than if you purchased a standard property. So not only are you saving on the interest payments, your mortgage payments every month are going to be lower because of that. You're saving on a bunch of fees, but you're also often paying your house off earlier, especially compared to a standard 30-year fixed mortgage. So there is a lot of advantage for buyers to do this. So now let's go over the biggest advantage for the selling side of things when it comes to these assumable loans. And it really has to do with making your house more attractive to more buyers. In today's market, where it's harder and harder for sellers to get into escrow quickly and sell their homes because interest rates are high, it has significantly tampered down demand right now. If you're able to advertise that any buyer that walks into your property that can qualify can take over a 3% interest rate, 3.5%, 4%, 4.5% interest rate, it's going to be extremely attractive to a lot of buyers and draw a lot of attention to your house, and often is going to result in having your house sell faster and for more money. So if you have one of these assumable loans, you're really sitting on a gold mine when it comes to being able to differentiate yourself compared to anybody else on the market. So this is why you need to make sure you're finding this information out before you go into escrow, because it's going to be a giant advantage on the advertising side, so you and your agent can work together to develop that marketing plan to get as many people not only through your house and seeing your house as possible, but to understand what these assumable loans are, how the buyer can take advantage of it, and really go through the entire process with any prospective buyers so they know exactly what they have to do to qualify for these loan products. So those are the pros. Now let's go ahead and go over the cons. Let's start with the buying side of things. So really the biggest con for buyers is that typically you're going to need to have a pretty substantial down payment because you're going to need to cover the cost of what they're asking versus what they have left on their mortgage. And obviously home prices have risen quickly over the last 2 years. So typically home sellers are going to have a decent amount of equity in their house, so you have to be able to cover the difference. Now really the only way to get around this as a buyer, which again is not going to be for everyone, and you have to run the numbers to make sure it actually makes sense and that you end up still saving money, but often you're going to be able to take out a second mortgage to cover the difference in that equity versus the purchase price, and that way you don't have to put the entire down payment down. However, when you get a second mortgage, you have to realize that interest rates are typically going to be much higher for those. So again, the lender is going to need to run the numbers for you and see at the end of the day, every single month, does it make sense to do it this way? Is it actually saving you money? That's going to be a case-by-case basis. So if you don't have that giant down payment, there is a way you might be able to still use this product. However, it does make things more complicated and it's not going to work with every situation. So talk to your lender, figure out the numbers, and see if it makes sense for you. So another disadvantage of this type of product, which affects both the buyer and the seller, is that when loan servicers do these, typically it's going to take a little while to do, and the timelines can be unpredictable. So if you're a seller and you need to be out of your house by a certain day and into a new property, these type of products might cause some issues if the loan servicer is not responsive and they can't give you a good timeline on how long it's going to typically take for this whole transaction to happen. So again, when you talk to your loan servicer as a seller, you want to ask those questions. If I go through this, once the buyer submits the paperwork, How long does it take for them to get approved? How long can I get this thing closed? Because you want to know those timelines up front so you don't run into issues down the line once you're already in escrow. And on the buying side of things, it's the same thing. If you need to be in a property by a certain time, let's say your lease runs out or you've sold your last property and you're moving to this one, those timelines are going to be a little bit harder to stick by because it's not a traditional product. And especially right now, loan servicers have not been doing a lot of these over the last 15 years because in an interest rate environment that's continuing to go down over the last 15 years, these products were just really not needed. However, now the interest rates have shot up and shot up dramatically. You're seeing more buyers being interested in this. Unfortunately, the loan servicers haven't done these a lot, so it's going to take a little bit longer until these type of things become more commonplace. So again, you have to be patient. You have to know the timelines might be extended and it might be harder to get an exact close date with these type of transactions. So a third con to these products, and this one affects the buyer more, is that if the seller did use an FHA loan to get into the property originally, they're typically going to have mortgage insurance, which means it's going to be a slightly higher interest rate, and that really doesn't fall off. You have to pay it for the remainder of the loan unless the seller put more than 10% down originally when they did the FHA loan, and then that will typically fall off right now at year 11, and then after year 11 your interest rate would go down even more. So it's something that you want to talk to the seller about, figure out what they put down, and then figure out if it might go lower in the future if they put a significant down payment down, or if it's going to stay the same for the remainder of those 30 years. So let's say it's a VA loan. Well, typically the VA loan usually has a fee up front, so the interest rate remains the same for the full 30 years. So that's typically not something you're going to see change at all. Now, speaking of VA loans, let's go over con number 4. So if you are a seller and you have a VA loan, so you're a veteran, you get a VA loan, if the new buyer that's going to take over that loan is not a veteran and doesn't use a VA loan, then you can run into issues purchasing your next house if you want to be able to use a VA loan as well. Because until that first house you have is completely paid off, it's going to tie up your VA loan entitlement, and it's going to make it very difficult for you to purchase another house in the future using a VA loan until that's paid off. Now, if you were to sell to a veteran, so it goes from a VA loan to a VA loan, then that basically cancels itself out. The new veteran takes over that, and you get your full entitlement to be able to go out and use a VA loan again to purchase your next house. So if you are using a VA loan, it's something that you want to pay attention to when a buyer submits a purchase contract, just to see what type of loan product they're using, and you can weigh the pros and cons of that based on your financial situation and what you plan on doing in the future when it comes to home ownership. So another con with this type of loan product on the selling side of things is if you do not get a release of liability signed by your lender saying that they resolve you of any type of liability with this new buyer, you could possibly still be on the hook for this property if the buyer stopped making payments. The easiest way to take care of this is just to make sure when you're talking to your loan servicer, what paperwork do I need to fill out to get this release of liability? Most good loan servicers are going to provide that and make sure you sign that. However, it's going to be up to you as a seller to make sure you talk to the loan servicer and say, I need a release of liability form for this FHA or VA loan. Where is it? How do I get it? Can you send it to me? Let's sign it. Make sure it's documented. That way, if the buyer decides to stop making payments, you have absolutely no liability. So it's an easy thing to solve, but it's something that if you don't pay attention to and it doesn't happen correctly during escrow, it could cause a lot of issues in the future for you. So make sure you look into that as well. Now, the final con with this product is typically as a seller, you're not going to have the buyer fully qualified to be able to take over that loan until after you get an escrow, because they have to fill out all of that paperwork. The loan servicer has to make sure they're approved, and once they get approved, then they can qualify to take over the loan. But typically, you're not going to know that before you get into escrow. So it puts a little bit more risk on you, as well as the buyer too, because as a buyer submits an application, they don't 100% know if they're going to qualify. Like I said before, if the buyer does have a pre-approval and they're approved for a lot higher than whatever the loan amount they're taking over is, odds are there's a good chance they will qualify. However, it's not a sure thing until the loan servicer fully accepts it, because ultimately it's up to them who they're going to accept and who they're going to deny. So that is one more thing that you have to take into consideration as a seller and a buyer when you're thinking about doing one of these assumable loan products. Okay, so you know what these loan products are now. You know what typically you're going to have to do to qualify for them, and you have a good understanding of both the pros and the cons. The last thing I want to go over today is just kind of some best practices for both buyers and sellers to properly utilize these to give you the highest success rate possible in either selling or buying your home. So let's start with the selling side first. So I've talked about it already, but the biggest thing for sellers is you really just need to make sure that you're talking to your loan servicer if you have a VA or FHA loan and figuring out all these details before you even think about placing it on the market. Typically at least a month ahead of time, so you have time to get all the paperwork you need, as well as that you're going to give your agent enough time to be able to properly market this, because they should be marketing this on every single channel they can, because it's a significant advantage compared to most homes out there. So if you don't have an agent that understands these assumable loan products, you might be better served to find one that does, because it's something that's going to set you apart from everybody else. So you don't want an agent that doesn't understand this, because they're not going to properly market your house, and it's not going to give you as many offers. So now some best practices on the buying side of things. So as a buyer, you're still going to want to go through the standard pre-approval process from a lender for a few reasons. So number one, again, like I talked about at the beginning, if you're able to qualify for, let's say, an $800,000 mortgage, and you find a property where you're taking over a loan that's maybe $700,000, you're going to know going in and placing offers, there's a good chance that you're going to be able to qualify to take over that seller's loan. So the second reason you're still going to want to talk to lenders, get a few pre-approvals to find the best rate, is that I don't want to mislead you. These type of deals are not going to be 50% of homes you find out there. It's only going to be a select few, so it's going to take a while for you to find the right opportunity that's going to make sense for you. And you have to also understand, let's say the seller does have an FHA or a VA loan, but they've been in the property for 15 years. Odds are
I want to thank PennyMac Mortgage for being a good loan company. I've been using them for about 10 years. In the past, when I bought a property through a loan company, before I received my second payment, I was transferred to some other mortgage company. I got shuffled to PennyMac, and after using their service without hassles, or very few, I would not use any other mortgage company. They have assigned a loan officer, title company, and attorney from their mortgage assumption team to make sure this is a smooth process for me and my buyer. I also want to thank everyone in my video collection for their straightforward and honest description of the VA assumable mortgages, pro and cons. Thank you. Easy out.